What is credit? Simply defined, credit is the power or ability to obtain money, goods, and services at present time in exchange for a promise to pay money upon demand or at a future determinable time. So, what can it do? Credit can be used as a medium of exchange. Credit facilitates the production and consumption of goods and can result into economic growth. It can elevate people's moral standard since credit relies on trust. It can induce people to save, knowing they can gain profit. It allows businesses to gather large capitals to undertake large-scale production. It lets wealth be fully utilized by using fixed assets as collateral. Lastly, credit helps in the money supply's expansion and contraction through discount rates. Here are credit's characteristics. Credit is a bipartite contract always involving two parties, the creditor and the debtor. Credit is a pecuniary contract always expressed in terms of money. Credit is a fiduciary contract. When a person transfers ownership, this is based on trust and confidence. Credit always involves risk, the probability of loss from a debtor's default. Lastly, credit always involves futurity. Payment is always done at a future date. So why is credit important for us? Firstly, it allows the possible production of goods. Second, it is important in the distribution of goods by providing financial means to gain opportunities in both domestic and foreign markets. Third, it helps promote full employment. And on the consumer side, credit impacts the quantity of goods and services used. In the business cycle, credit can affect and be affected by the ups and downs of the economy. During recession, when the economy goes down, business and consumer products decline, and so does the need for credit. But come recovery and prosperity periods, general optimism leads to increased purchase and increased credit. When in recession, credit can soften the downward trend of business activity, but at a big risk. This scares creditors to instead tighten credit policies by raising the credit standard and the quality on required collaterals. On to the form of credit. First is personal credit. These are used for oneself and have three types: service credit, retail credit, and personal loan credit. Service credit is obtained from professional services like doctors and lawyers. Personal loan credit is in the form of money instead of goods and services and can be obtained in places like banks and pawn shops. And for retail or consumer credit, it has three categories: the regular charge account, revolving charge, and installment plan. In regular accounts, you pay for the charged good within 15 to 20 days. Revolving charge credit is divided into amounts to be paid in longer periods. Installment plans resembles revolving charge, except that it usually requires a down payment. Its payment period is between 12 to 36 months, secured by a chattel mortgage, and is only for durable goods. The criteria for granting personal credit are 1. Employment, and 2. Personal resource. Regular income is more prized than irregular, and some occupations are better risk than others. Other factors are the borrower's operating expenses, additional income source of the family size, and the borrower's paying habits. The Truth in Lending Act is meant to protect consumers against unfair billing practices. This law requires creditors to inform all customers 7 things before consummating their transaction. 1. The cash price of property to be serviced. 2. The down payment, if any, or the trade-in price. 3. The difference between the amounts of 1 and 2. Number 4. The charges individually itemized. Number 5. The total amount to be financed. 6. The finance charged in terms of pesos. 7. The percentage that the finance charge pressed to the total amount to be financed. The next form of credit is commercial or mercantile credit, credit extended by businessmen to businessmen. Merchandise or trade credits are in the form of goods, differentiating them from cash credit. They can take place from the time goods are sold as raw materials to the time they are sold as finished goods, but this does not reach retailers to consumers. Commercial credit is generally an unsecured short-term type of credit where most commercial enterprises are both debtors and creditors. Bank credit or bank loans are granted by the banks to businessmen to finance their short-term needs. Commercial banks usually give these to finance current business operations, good in process, or purchase of inventory. In traditional theory, commercial banks are limited to short-term loans, but since customers have more needs, banks have expanded into a wider variety of loan programs. Export credit finances selling goods outside the country, while import credit finances buying goods. Both are obtained from the bank. These credits come through the forms of letter of credit and drafts. This is how the process looks like. Investment credit or long-term borrowing is a common form of finance and is used only for investment purposes, such as fixed assets like land. Agricultural credit is given to farmers for the development, improvement, and cultivation of their land. Their principal supporters are the Development Bank of the Philippines and the Land Bank of the Philippines. These are in the forms of 1. Crop loans, given to farmers for the financing production of crops. 2. Livestock loans, used to finance raising of livestock. 3. Agricultural time loan, financing of farmland's development and improvement and to buy farm equipment. And lastly, 4. Commodity loan. This finances the selling and distribution of crops that are evidenced by warehouse receipts. On to industrial credit. These are granted to industries to finance the acquisition of machineries, the construction of factories or plants, and to some extent, the purchase of raw materials. Real estate credit finances the purchasing and improvement of real properties like houses. Government or public credit is obtained from any of the government institutions or their instrumentalists. The debtor may be the national, provincial, or local government, financing the buildings of roads, bridges, or dams. Secured credits are covered by collaterals, properties of value that are completely given to creditors when debtors default. Unsecured loans are credits given in trust in exchange for promise to pay. Short-term loans are payable within a year. Medium-term loans are payable in 1 to 5 years and are sometimes called intermediate-term loans. Long-term loans are beyond 5 years and are usually up to 15 to 20 years. For direct loans, interest payments are made at the time the loan matures. For discount loans, interest payment is already deducted at the start, so the debtor gets only the principal minus the interest and pays only the principal in the end. Credit line is an agreement between debtor and creditor of a certain amount of funds that the debtor may borrow. There are 3 types: regular credit line, maximum loan commitment, and overdraft line. Regular credit line allows the debtor to borrow to a certain amount. As long as they are paid when due, the loan automatically renews. Maximum loan commitment funds are not renewed, even when paid. The most that the debtor can avail is the agreed credit limit. In overdraft credit line, the bank allows depositors to draw from the bank beyond their deposit. These are within an agreed amount and interest is charged on a daily basis. Today, this loan is no longer allowed. Sources of credit. Banks, the most common source of credit. This is classified as commercial, thrift, rural, and specialized government banks. Commercial banks focus on giving commercial loans to businessmen. Rural banks cater the needs of farmers and small businessmen in rural areas. Thrift banks are subdivided into 3 categories. The first category is the Savings and Mortgage Bank. Through depositor savings and the bank's capital, it invests in marketable securities like bonds. Second is the Stock Savings and Loan Association, investing in the securities of the government or of productive enterprises. The last category is Private Development Bank. This bank aims to develop and expand the country's economy pursuant to the government's socio-economic program. Other sources of credit include retail stores, credit unions, individual money lenders, insurance companies, and sales finance companies. On to credit risk. This is the possibility of non-payment of the obligation when payment falls due. This can be minimized by careful examination of the 5 C's of credit: character, capacity, capital, collateral, and conditions. Character is the debtor's quality of intending to pay when the debt is due. Capacity measures a borrower's ability to repay a debt by assessing the borrower's debt-to-income ratio. Capital is a business financial strength, a guarantee that transactions can be redeemed. Collateral acts as a backup source if the borrower cannot repay a loan. Condition is the customer's environment, external factors that the applicant has little to no control but is influenced by. The 2 types of movements are regular recurring seasonal activity and regular oscillation of business as a whole. There are various sources of credit information. Application form is the best source of data. It's 1 to 6 pages long and is only filed once. Personal interviews are the cheapest and easiest source. Direct contact allows personal assessment and verification of information. General Mercantile Agencies provides assembled credit information from all parts of business fields of operation, trying to keep it as updated and complete as possible. It is both extensive and intensive. Dun & Bradstreet is the oldest and most frequently used general mercantile agency. It is very reliable and requires no further investigation. Special mercantile agencies or trade agencies have a limited scope of coverage to a single or limited number of allied trades. Personal Investigators has a staff of full-time reporters and independent correspondents in remote areas. Public and published records consist of all legal recordings like deeds, suits, and newspapers. Credit bureaus are businessmen associations that gather information from each other. There are two kinds: Retail Credit Bureau and the Credit Interchange Bureau. Retail Credit Bureau are mostly local merchandise in the form of local credit association. Credit Interchange Bureau is the exchange of information among local credit bureaus. Bank Credit Department is one of the best sources of credit information since they very much evolve with their customers. Credit instruments evidences the existence of a credit obligation. There are three kinds: open book account, a mere entry on the book showing existence of a credit transaction. Number 2, promissory note, an unconditional promise in which the debtor promises to pay on demand on a determinable time. And number 3, trade acceptance, a draft drawn by a seller upon purchase, payable to the seller as payee and accepted by the purchaser as evidence that the goods shipped are satisfactory and the price is payable. Credit instruments are classified into two broad classifications: credit instruments with general acceptability, which are in the form of banknotes, treasury certificates represented by paper money fully backed by gold reserves, or fiduciary paper money partially backed by gold reserves. The second one is credit instruments with limited acceptability that are used for A, investment purposes, and B, for commercial purposes. Credit instruments for investment purposes are subdivided into stock certificates, which evidences the ownership in a corporation, and are divided into preferred stocks, which have special privileges, and common stock, wherein the holders enjoy only the fundamental rights and entitled to residual claim of the business. Bond certificates are evidences of indebtedness that can be used as collaterals for loans. There are debentured bonds, an unsecured bond issued against the general standing of the user; collateral trust bonds, secured by a pledge of corporation stock and bonds and evidence of indebtedness of other corporations; mortgage bond, secured by a mortgage on real properties of the corporation; sinking fund bonds, bonds requiring a reserve fund accumulated from the annual income of the company; registered bonds, issued in the name of a particular person or entity that is registered in the books of the corporation; guaranteed bonds, whose principal and interest payments are guaranteed by a company other than the issuing corporation. Convertible bonds can be exchanged with other securities of the corporation. Redeemable bonds, bonds can be redeemed or paid off by the issuer prior to its maturity date. Serial bond is structured so that a portion of the outstanding bonds mature at regular intervals until all of the bonds have matured. Income bond is a debt security in which the issuer is required to pay interest only when interest is earned. Coupon bonds used to come with detachable coupons that could be cashed in for interest due. And last is profit-sharing bonds. These are allowed to participate in the earnings of the company in addition to the interest payments. Another instrument used for investments are money market bills, which are negotiable financial instruments bought and sold in the market. These are the kinds of money market instruments. Interbank call loans, a short-term money market which allows for large institutions. Promissory notes are short-term indebtedness issued by institutions as direct obligors. Repurchase agreements sold by dealers to buyers at an agreed price. Certificates of assignments represent prime loans granted by commercial banks which are participated by several investors. Certificates of participation are funds invested or reinvested by the trustees in such investment outlets, includes those banks owned by the trustee or its subsidiary or affiliates as may be authorized in the contract. Commercial paper is an unsecured short-term debt instrument issued by a corporation typically for the financing of accounts receivable, inventories, and meeting short-term liabilities. CBCI, Central Bank Certificate of Indebtedness, are tax-free and earn reasonable rate of interest, eligible for reserves and acceptable as collateral for loans. Treasury bills are bearer notes or debt instruments sold at a discount by the central bank. These are liabilities of the Philippine government to pay the bearer a fixed sum after a specific number of days from the date of issue. DBP, progress bonds, are issued by Development Bank of the Philippines and secured by their assets. Other government securities include PE and ED bonds, represent direct obligations of the Philippine government for public work projects. LBP bonds are obligations of the Land Bank of the Philippines. Treasury notes have an original maturity on 1 to 10 years and pay coupon interest semi-annually. Treasury bills carry any original maturity, but typically are issued mature beyond 10 years. Bonds are long-term indebtedness issued by any government entity. ACA notes issued by Agricultural Credit Administration. EPZA bonds issued by Export Processing Zone Authority used to finance housing development in Bataan Export Processing Zone. Others are socio-economic bonds, Premyo, saving bonds, Biglang Bahay bonds, NFA bonds, NDC bonds, LRT notes, and Bahayan certificates. Credit instruments for commercial purposes are further divided into promise to pay and order to pay. A promise to pay involves two parties, the maker who is the debtor and the payee who is the creditor or party receiving payment. The instruments consist of A. Promissory note, a written promise to pay certain amounts of money, demand, or the demandable future time. Kinds of promissory notes are negotiable promissory note that is transferable, non-negotiable promissory note which is not transferable, 3. Secure promissory note which is guaranteed with the properties of value, 4. Unsecured promissory note greatly dependent on the character of the borrower, 5. Financial institution deposits are promises of certain institutions to return money deposited to them. 6. Letter of credit is a letter made by one bank addressed to another bank, foreign or domestic, requesting to honor drafts drawn in behalf of a third party. And 7. Open book account, a mere entry in the book showing existence of a credit transaction. An order to pay involves three parties: the drawer who orders payment, the drawee who ordered to pay, and the payee is the receiver of the payment. Checks are the commonly used bills of exchange for satisfying credit obligations. Can be defined as an order of a depositor to his bank, requesting it to pay to a person named therein. Checks may be classified as cross checks, post-dated checks, stale checks, manager's check, cashier's check, treasurer's check, bouncing or rubber check, counter check, certified check, voucher check, and cancel check. Advantages of using checks are A. They are easy and safe means of paying, B. Easily negotiated, C. Can put a stop payment, D. Forged checks are bank's responsibility. And lastly, checks cancelled by the bank may serve as receipts for payments made. The disadvantages are they are not readily accepted for payments, and drawers have to carefully keep track of their deposits.